Okay, hello everyone. Welcome. Thank you so much for joining us. This is our 13th Michigan Investor Group meeting, which we also refer to as MIG. And like I mentioned, I'm just really delighted to get back together. This is our first virtual meeting. The rest of the meetings have all been in person, but you know, we gotta make the best of it for now. So tonight we're gonna have another discussion about a couple topics we've discussed in the past. Tonight we're gonna talk about investing in mobile home parks and in self-storage facilities. And our agenda for the evening, all the official discussions and events will be done by 9 p.m. Eastern at the latest. So you can rest assured, probably even a little bit earlier. I'm gonna share a couple moments about how I met our presenter, Jeff Cook, and then I'll introduce Jeff. And then Jeff will share probably a 15, 20, 25-minute presentation, and then we'll have some question and answer time. And that's kind of the plan. If you have questions during the presentation, either write them down or just put them in the chat room, in the chat function, and we'll get to them. And if you're interested in any of this and you want more information, you can just email me and I'll, connect you with Jeff directly, or you'll see his email address here soon, and you can get a hold of him directly too. Okay, so a lot of you know that I've been pretty interested in the mobile home park space for the last 3 or 4 years, and probably some of you ad nauseum have heard me talking about it. But that's kind of how I met Jeff back in 2018, just trying to, I guess, broaden my network and of different mobile home park operators who were looking to raise money from passive investors. And through some connections, got referred to Jeff Cook, and ended up going to visit him and spend a day with him out in Rochester, New York, and was able to meet his team, tour several properties, and just build a relationship. And it's been positive so far. My family and we have invested in 2 single park mobile home park syndications with Jeff. Jeff has been in the real estate business for, I want to say, 20 plus years. And he's got several different asset classes that he owns and manages, but his focus has shifted to the mobile home park and self-storage space in the last few years, and he'll tell you a lot more about that. I guess I'll just like to introduce Jeff and look forward to what Jeff's going to share. So welcome, Jeff.
Thanks, David. I appreciate it. I apologize, for some reason I can't get my video up and running. But don't worry, you're not missing much. I'm a fairly handsome guy, but nothing, certainly not a movie actor or anything like that. So, but if anyone really wants, I certainly can send a picture later. Well, thanks for the kind words, David. I appreciate it. Yeah, David, I enjoyed meeting David. Like you said, he came out a couple years ago, flew in, and we were able to spend the whole day together, share some stories, share some experiences. And like he said, he's invested in a couple of our properties, and we've also have used some of David's advice for me and Brian to invest in some other investment opportunities also. So me and Brian, we love mobile home parks. We love mini storage facilities, and that's why we created our Cook Properties Fund 20. We're looking to only invest in mobile home parks and storage units. We do expect it probably to be about 75 to 80% mobile home parks, and then the remaining 20% of the fund to be storage facilities. Can everyone see the slides okay? Yeah?
I see them, yep.
Okay, good. So you guys, I know we can email you this presentation later if you want to take a look at it further. But as you can see, our goal is pretty much what I just said. We're looking to fund a private real estate equity fund, just focusing on mobile home parks and storage facilities. We're looking to conduct our business here in New York, Ohio, Massachusetts, and Pennsylvania. I think our primary focus is going to be New York State. I think probably about 85% of our properties that we purchase will be in New York State because that's where we're based. That's where all of our properties are now. I just want to leave the option open for some adjoining states. So whether we expand into those states during this fund or not, if we don't, it certainly will be in the next one. We're looking to provide returns in the 10 to 14% range, annual cash on cash returns, and we only buy properties that are cash flowing from the beginning, from the outset. Just give you a little background about me and Brian. It's a family-owned and operated real estate development business. We own mobile home parks, storage facilities, office buildings, some retail plazas, and some warehouse and flex spaces. We have by the end of the year, we'll have about 2,500 mobile home pads throughout New York State. It's about 27 parks. We also have about 220,000 square feet of office and retail, and 5 storage facilities with about 2,000 storage units. Our paramount concern has always been our customers. If we have happy customers, we have a healthy bottom line. Me and Brian have always taken the attitude as we treat others, as we want to be treated, and that has served us very well over the past, all of our lives, but certainly in business here over the past 20 years. Here's just our current locations in New York State. There's a few parks that aren't on here that we have purchased since we did this map, primarily in the Buffalo area. So as you can see, we crisscross the state. We from west to east, south, north to south. In general, we like to stay, along the thruway and up and down 81. It's just a few case studies. I'll just go over these briefly. Bergen and Leroy Self Storage is a storage facility, 2 storage facilities outside of Rochester, New York, where me and Brian were born and raised, and where our office is right now. It was our first storage unit property. We bought it. It was about 50% vacant. We got a pretty good deal at the time. We thought it was a good deal. It took us about 12 months, and we were able to turn it around and lease it up. It was a mom and pop type of property, and it was a good property for us. We've refinanced it, I think, 2-3 times now, and it's good. It's been a very profitable property for us. I think our biggest obstacle, obviously was the vacancy, and we found that we were able to fill that simply by paying attention to the phone calls. Believe it or not, the previous owner had a manager that was not very, I don't want to say not friendly, but wasn't. Things had to be on his schedule, and me and Brian were much more flexible on doing move-ins and such. And we've owned that property about 12 years ago, so that's something that me and Brian, we would do our own move-ins and just manage it from the beginning to the end. We still own that property. We still own that property too. Schoolhouse Estates and Isle of Pines. That's 2 mobile home parks that me and Brian bought, again, about 10 years ago in Waterloo. It's about 45 minutes outside of Rochester. When we bought both of them, they were each about half occupied. Since then, they are completely full. We've actually done an expansion in the Isle of Pines Park. We just finished. It was a 16-pad expansion that we actually have all the homes in there now. And I think we might have 1 or 2 left. That was so successful that we actually bought the land adjacent to Isle of Pines, and we're going to put another 20 homes over in that on that land this coming year in 2021. Heritage Acres, that was another early park. We probably owned that about 5 or 6 years now. When we bought it, It didn't have a whole lot of vacancy, maybe, I don't know, maybe 10 pads or so. But the biggest issue was the water was not separated. There was a lot of vacant park-owned homes, and that's how we were able to drive the NOI up by separating the water and filling the vacant park-owned homes. And since then, we have also filled up all the vacant pads, so we are pretty much 100% full. We also are in the process of we have vacant land for about maybe 50 homes, and we are in the process of getting approvals for that right now. We're doing that expansion process with vacant land in I think 3 or 4 of our parks right now. We refinanced that property 2 years ago, I think, and we probably are going to be doing another refinance this in 21 to do the expansion. Valley Manor, that's a mobile home park right outside of Ithaca. It's in Newfield. That one was a grand slam. You know, we always shoot for singles, a minimum of a single, but that one so far has been a grand slam, and we still have a lot of value left to achieve. Within a year, we refinanced it for about $1 million more than what we paid for it. We still have about, I want to say Brian, maybe 20 more pads that we can fill up over there.
Yeah, 20, maybe 25 pads left.
And again, we just refinanced that last year, and the bank, it was a local regional bank and not super aggressive on parks. They only wanted to go up to a 65% LTV, which we did. But we'll probably refinance that again probably in 22 after we fill up the rest of the pads.
So Jeff, is your philosophy is to buy and hold and manage, correct?
Absolutely, yeah. So I've been in real estate for a little bit over 20 years. We've only sold a few properties. Notwithstanding, my original properties were apartments in the city of Rochester. I had about 100 units. Dwindled down a little bit. Ended up selling the balance of about 65 units as a package. But besides those, me and Brian have only sold 2 other properties. Once we find a property, you know, for the most part, if we like it, which again, we've only sold a couple properties, we like it. We know, you know, within a year, we know all the secrets. We don't like to sell unless we know what it's doing and we know what to expect. We like to keep it.
We got a question. Yeah, we got a question from Derek. I don't know if you can see that, Jeff, but Derek wants to know if we self-manage or third-party manage.
We self-manage. We have 13 in-house employees. About half of them are our regional property managers. The other half is accounting, and then we have another 20 or so on-site managers and maintenance personnel throughout the state. We will, I don't say never, but at this point we do not want to, nor do we have any intention of using third-party managers. How did you see the question, Brian?
It was under on the bottom. It's under chat. There's another question from Ryan. Do you own the mobile homes?
Oh, good.
Or just the pads?
Brian, Brian, if you could keep feeding me the questions, that'd be great. So Ryan, we do own some homes. We probably own, I would say, roughly 20% of the homes in our parks. With the vacant pads, we found that the best way to fill them is by bringing our own homes in. We used to bring in just used homes. Now it's 99% brand new homes. We use our management company.
Owned by the fund?
The homes are owned by the management company, which is Highland Holdings. They'll be booked under the property. So whatever property they reside in is where they will where they'll be booked. But ultimately, they're still owned by our management company, Highland Holdings. And the main reason for that is the financing purposes. It's a lot easier to get them financed through our company and through the manufacturer, just by having a single entity like that me and Brian are participants in.
Does the income from the ownership though flow through to the fund that we would be investing in? Let's say if we invested with you, or does that fall to your personal management company?
No, great question. And all of the expenses and the income of the home, once it's sited, or even before it's sited, flows through the property and the fund.
Hey, Jeff. Jeff Cook.
Yeah.
Maybe could you? Some people here maybe don't know the difference between mobile home park, owning the home versus just owning the lot. Could you want to explain that difference?
Yeah, of course. So our goal, and most MHP owners, the goal has always been to not own the homes, but to fill the vacant pads, you really have to be aggressive, and to do it quickly or relatively quickly, you have to bring homes in. When we bring homes in, probably 80-90% of the time, we end up renting them. The other 10 to 20%, we end up selling them. The difference is a resident-owned home, is a little bit less maintenance. They own the home themselves, versus a park-owned home where the property, or us as a landlord, we own the home, and we're as such responsible for the maintenance. Since we're bringing in all new homes, primarily brand new homes, maintenance is very minimal. There's not, given that they're new homes, there's not going to be a lot of things breaking. We try to take a few steps to avoid issues on turnovers. We don't use any carpet. We use vinyl throughout the whole home, so we avoid any replacing of carpet. And for the most part, we do own some apartments. We find that our residents, even if they are renters, they still treat the homes much better and stay much longer than our apartment residents do. It's for the most part, yeah, go ahead.
We're getting a lot of questions, so I think maybe, Jeff, if you could maybe move through your presentation, it probably is only going to take you another 5 or 10 minutes, and then maybe we'll do questions at the end, because you're gonna address some questions about your team and your structure and the fund
sure.
as we go through this. So let's just plow through the presentation, and then we'll focus on Q&A after.
All right, sounds good. Thanks, David. So Dutch Village, I'll go through these real quick, because I'm sure the questions are going to be much more helpful for everyone. Another park that we bought right outside of Albany. We bought that about 3 or 4 years ago. Again, we had some vacancies. We separated the water. Rents were below market, so we raised rents, and we were really able to drive the NOI. That is another park where right now we're in the midst of doing a 50 pad expansion. We're just waiting on approvals. Wayne County Properties, that's 2 parks outside of Rochester, just under 200 pads. We've only owned that for a couple of years. When we bought it, we had about 20 vacant pads in each park. We're slowly filling those up. Probably one of our biggest projects is one of the parks is on a failing septic system, which we knew when we bought it, and we priced it accordingly. We are putting a brand new sewer system in for that park, and the closest sewer line is a mile away. So we're going to be running the sewer line a mile down a county road. We should be breaking ground on that in the spring. We're just waiting on final approvals for that from the town. We're very excited about that. That's going to be a big deal for us.
You're showing that you installed 20 new pads for that?
Yeah, yep, that's correct. We've just to give you an idea of our overall portfolio, last year we put in, in 2020, we've put in 50 brand new homes. We've ordered 75 for 21 already. Every time we bring a new home in, we put a new pad in. Probably, I don't know, maybe 60-70% of the time we put in new utilities to the pad and new driveway. And it's a nice brand new home. Cost us about approximately $45,000, and then we either sell or rent the home.
And the municipality is not really a problem? You get permission to add that? Or do you have to
Yep,
get
we
permission?
we have to pull a permit, of course, for each home, but they're happy to have the home in there. It brings in a little bit of extra tax revenue for them, and generally a little bit extra water use and income, and sewer use and income.
Oh, thanks.
Yeah, of course. So I talked a little bit about the fund. One of the nicest things about the fund is that it provides diversification. Me and Brian have been doing property investing like this with the outside investors for about 5 years, and it's always just been one property at a time. And what's nice about the fund is that it provides diversification. So any one of our investors is going to be diverse. Their investment is going to be diversified across, approximately 10 properties. With the $20 million raise, we'll be buying approximately, $80 to $90 million in real estate. So you'll have a nice portfolio of real estate. Again, primarily in New York State, but we still may have the opportunity to buy some good stuff in Ohio, PA, and Massachusetts. So again, we're expecting annual cash-on-cash returns in that 12 to 15% range. There's an 8% preferred annual return, and what we'll do is each quarter we'll reconcile the 8% with what the actual return was for the previous quarter. So let's just say, for example, January, February, March, you'll get 8%, and towards the end of April, once we reconcile the first quarter, you would get not a bonus check, but you would get the difference of the actual return minus the 8%. So say it's 12%, you would get a 4% additional return. $50,000 minimum investment. The fund, which is what everyone will be investing in, that will own the properties. And distributions, like I said, are paid monthly. We're hoping we want to do a hold period of 10 years. But that's, if there is an issue and someone does need to get out for whatever reason, their share can be sold to another individual or another group. Me and Brian as GPs, general partners, just need to approve of it. Obviously, we would not unreasonably withhold any approval. It's just something that we need to maintain. So yeah, 10-year hold period. Our plan and our hopes is that everyone's going to be getting the returns that they're expecting, so there won't be any need or any desire to get out of the investment. At the end of the 10 years, we plan to sell the properties. Some people may want to hold on to the properties. So some people at that point, there'll certainly be an option to stay in also if we decide to keep some. Now I'll let you guys read through. It's just a little quick bio about me and Brian. Irene, she's our controller, and then just all of our other employees. So I think now is just a great time to open to questions. I guess one thing just to say is that me and Brian love this. We love what we do. I've been in real estate for over 20 years. Brian joined the company about 10 years ago. Brian's a retired airline pilot, and we love what we do. We're here at the office, I don't know, at least 6 days a week, sometimes more, and working many hours. But it's something that we enjoy, and we're really good at it too. So we'd love to have anyone on board that wants to come along. We're confident in our abilities, and our track record shows it. And we expect that to continue moving forward.
Okay, Jeff, thank you. Thank you for that presentation. Everyone, I'm going to ask a couple questions for my notes, and then I'm going to jump into the chat room and ask some questions there. So a couple softball questions for you, Jeff. What about rent control laws in New York State?
That's a great question. So rent control was passed summer of 18. So right now in New York State, we're limited to raise rent by 3%. So fortunately, all of our parks that we own now or that we are considering buying, the rent is close to market rent. So we don't have any issues with being, way under market rent. And at this point, when you can only raise 3%, it's going to be difficult to get there in a timely fashion. That's really the biggest thing with the rent control. There's a couple other small things, but for our purposes, that's really the biggest hurdle. So this year for 2021, we raised the rent 3% like we could. Next year, there's actually an opportunity to raise it another 3%, so you could do a 6% total. The only thing you got to do with that second 3% is prove it to the state, and not to the state, but just have your guns ready, have your ammunition ready, because they can challenge it. So at a minimum, you get 3%. At a maximum, you can get 6%. And so that's what we're gonna try next year. We were gonna do it this year, but with COVID, we just decided it wasn't a good time.
Okay.
So
And,
we're not scared. Dave, just real quick, we're not scared of rent control. We kind of saw it coming here over the last, so it's always been in the state legislative for the past several years, and it did end up getting passed there in 18. But me and Brian, we're not afraid of it. We're hardy New Yorkers. We know what's going to happen in New York State. We're familiar with the unfriendly business climate, and we're still making a real good go of it and being successful.
Yeah, you got to watch those state legislatures. That's for sure.
I know, right?
How about population and migration trends? You talk about filling in a bunch of your vacancies, but it seems like we hear about people moving out of the state. Is that different from what you're seeing?
No, I mean the statistics. You're right. The stats show that people are moving out of New York State. What we're finding though in our parks is that we cannot bring homes in quick enough. Our homes are sold or rented before they're even done. And I think the primary reason for that is one, the need for affordable housing, and two, we provide a great product. I mean, anyone who's listening is more than welcome to drive through any one of our parks at any time, and we would have no problem with that, and we would be proud of what you guys find. But yeah, our demand is great. It's our biggest problem here just in the past year has been getting homes. The supply chain for new mobile homes is pretty slow right now. Like I said, we ordered 75 homes when, Brian, back in the end of the summer?
Yeah, and we're just starting to take delivery here in right now, actually.
Yep. And then more in February, right? February and January.
Yep, February and January, and 75 total.
Jeff, are any of your current holdings that you already own being considered to be acquired by the fund?
They are not. I know a lot of sponsors and equity funds do that, but we are not. We're only going to be going forward with new properties.
Okay. How do you guys find the deals that you're looking at? And then follow on, if all your holdings are currently in New York State, what efforts do you have to look for properties in Pennsylvania and Ohio and stuff?
Yep. So pretty much all of our deals come off market. We've been in real estate here for 20 years. We have a lot of great relationships with brokers and just other people in the industry. We have a really good track record as far as closing on deals. So if a broker brings us a deal and they know it's a good deal and there's no hidden issues, they know that we can get the financing and that we can close on the property. They also know that we're not going to nickel and dime a seller over a few bucks here and there. Obviously, if there's a big issue, a major issue with the infrastructure or title or something like that, that it'll be taken care of, or we'll have to walk away.
Okay.
Yeah. So
when did this fund launch? And have you started raising money already?
Yeah, we launched it just a couple of weeks ago. We already raised money. We've already been raising money. We're already well into the seven figures, low seven figures. We have 3 properties under contract right now that we are going to be putting in the fund. 2 mobile home parks in the Buffalo area, about 255 pads total pads. Beautiful parks, some upside. With one of the parks has about 15 vacant pads. And then the other park that we have under contract that won't close until January is a local park, 132 pads, again, with some upside, primarily through management efficiencies and taking care of delinquent tenants.
Okay. Jeff, you mentioned earlier kind of estimated or forecasted cash on cash returns of 12 to 14%. Do you think does that need some time to mature, or would that be happening like in the first quarter or second quarter after investing in the fund? Or would it take maybe a year?
Great question. Sorry, go ahead.
No, or would it take maybe a year before that would start happening?
No, all the properties we buy are cash flowing from day one. The 12 to 14% is what you would get again from day one. So, we have the 2 properties in Buffalo right now that we're looking to close on, and that we're pushing hard right now for the equity raise. So, say we want to close on those. We're planning to close on those here in December. So, if an investor were to come in, they would start getting distributions in January. So it'll start right away. There's no hold period or no period where you won't be getting a distribution.
Okay. So these park owned, so maybe you want, maybe you talk about renting the park owned homes. When you guys rent a park owned home, is that traditional rent, or is it like on a lease to own where the tenant has an option to buy it and you're giving them credit, or is it just a complete rental?
It's a complete rental. That was one of the things from rent control that took the rent to own or lease to own away from us as landlords. If someone's going to figure it out, we haven't looked at it yet to get around the whole issue of that not being allowed anymore. So right now, that's why we only do rentals or sales. Okay.
And just so everybody knows, a lot of mobile home park operators, they'll like take $1,000 down payment, and then they'll, basically finance kind of, in a roundabout way their tenants to end up owning the home. But it sounds like New York State has put some restrictions on that.
Yeah.
Okay.
So what happened, Dave? What happened is if you evict a tenant, and you were doing a rent to own situation, the tenant could demand that you return all of their rent, not the lot rent, but their rent to own payments. So for that reason, we're not doing it anymore, which is, it would be ludicrous to do it at this point. There are some new programs that are coming around, sponsored by the state. We looked at some of those, and again, they're state sponsored, so they're heavily in favor of the tenant. We're also looking into, we have enough volume where we're either close or already there to become an MLO, which is a mortgage loan originator. And so we are looking into doing that also, where we would provide our own mortgages, which of course would be legal in New York State.
Okay. You talked about buying some parks that were 50% or 60% occupied, and that after a couple of years you've got them full now. What's your secret sauce for that?
We provide a great product. Brian is all about operations and efficiencies, and he's the one in charge of running the parks once we get them acquired. It's providing a good product, being a good landlord. We hear stories all the time about how horrible landlords are, and if we have residents, which we do, that pay their rent and they're fair to us, we'll do whatever we can to make them happy. So essentially it comes down to resident satisfaction. We provide a good product. We expect them to pay for it at a fair price, and we'll take good care of them.
Okay. Can you get into a little more detail of kind of the structure of the fund? You mentioned the preferred return to 8%. Can you talk about is there a profit split above the preferred return?
Yeah, so it's 80% to the investors, and then 20% is call it the sponsor fee for me and Brian.
And so is it, so let's say, you have cash flow coming in, and the first 8% of any distributable cash flow is going to go to the limited partners or the passive investors. And then
Correct.
After that point, do the limited partners get return on capital back first, or do you immediately start participating in 20% of the above pref?
Yeah, we start participating. Me and Brian as the GPs, we start participating right away.
Okay. Is there a acquisition fee?
There is. It's going to vary by property, anywhere between 1% and 2%. Historically, we've been more 1 or 1.5. I don't think we've ever done. Actually, I'm sorry. It's 1 to 1.5% for the acquisition fee. There's a fund management fee of 1% for the actual fund itself, and then of course we have our management fee for the individual properties. But I just remind you that the anticipated returns there of 12 to 14% are net of all fees. So that's bottom line after all expenses and debt.
Okay. This might be a little bit specific from park to park, but let's say, I don't know, in your markets, what are the average costs to buy a 3-2 house in your markets?
A stick built?
Yeah, a 3-bed, 2-bath house.
Yeah, again, it is gonna vary quite a bit because we have, from like Buffalo, Rochester, Syracuse, they're kind of all the same. But then you start getting like Albany or closer to New York City, and then the prices go up quite a bit. I mean, in the suburbs where our parks are, you can't get anything for under $100,000 that's even halfway decent. I would say you're more looking in the mid to upper $100,000 range for a 3-bedroom, 2-bath house on a quarter or half an acre.
Okay. Yeah, a lot of times, I mean, I'm not an expert, but a lot of times some of the quick and dirty analysis says if the average single family home price is over $100,000 and you're within a couple miles of your mobile home park, that's generally a pretty good signal that you're gonna so okay. What software do you guys use to manage your real estate, your rent collections?
We use Rent Manager. We've been using that for a couple of years now, almost 3. How long, Brian? Almost 3 years now.
Yeah, it's been 3 years, and we're very happy with it. It works great, and as we're acquiring more and more properties from sophisticated sellers, we are taking advantage of all the data that's easily transferable from other Rent Managers users.
Okay. And how about, you guys have a financial software system for the investment holdings, or is that kind of, you guys build that yourself?
A combination of ourselves, and then we actually use Rent Manager too for that also.
Okay. Okay.
Yeah, we're still learning Rent Manager. There's just so many bells and whistles to it that we're still learning even after 3 years.
Okay. I think we've asked this question, but let's ask it in a different way. What % return, or what kind of return would be expected on a $50,000 investment, and when would you envision that to start distributions being paid?
Yeah, so if someone invested $50,000, we'll go in the middle. We'll say 13%. So you would get about $6,500 per year. Pay that monthly. You're looking at $541 per month. If you invested right away, then your first, because we do have properties in the hopper that we're looking to close on, And if we closed on those in December, you would get a distribution in January. We pay all of our distributions right around the middle of the month. We aim for the 15th, but that's plus or minus, a week to 10 days.
Okay. When you guys, if the supply chain works for the new mobile homes, how do you guys finance those purchases?
Yeah, another great question. So we were using Clayton Manufacturing, and they manufacture a decent home, but they didn't provide any financing. So we were using 21st Mortgage. They were a decent financing company, but not quite what we were looking for. So we found a new manufacturer, Colony Manufacturing. They have several locations throughout the Midwest and the Northeast. We use their location in Western Pennsylvania, and they are nice enough to finance the homes for us. So we finance the homes. We finance the homes through them, through our management company, Highland Holdings. And just to give just a rough outline, when we bring that home in and we have a new resident that comes in and rents it, their home rent covers our mortgage and then some on the house, and then our profit is the lot rent. And that's really our goal is to get the lot rent. So we don't care if the mortgage and their home rent cancel out each other. We do 10-year term loans on the homes with a 7-year balloon. So we're going to pay those off in 7 years, and at that point we will have gotten all of our money back from those homes. We'll own them free and clear. At that point we can, and even beforehand if we wanted to, but certainly at that point we can sell them for a very, very aggressive price.
Okay. This is another question about the rent control. If you bring in a new home to rent, how does the rent control apply to a new home?
Again, another good question, and I should have been clear about that earlier. So rent control only comes into play in all of our communities if the current resident is staying there. So for example, if you have a resident who has been there for year after year after year, you can only raise the rent on them the 3% plus the potential other 3% that I talked about earlier. Now, if you bring a new home in, or a resident sells their home to a new resident, and then you can raise their lot rent to market.
Okay.
So on turnover, you can raise the market, which for us is not a big deal because again, we're buying parks that the rents are close to market, and all the parks that we currently own, they're close to market also.
Okay. And then I'm probably at fault for this, but one of the questions that came in was, will the properties in this fund be a mix of mobile home parks and self-storage? I'm monopolizing the discussion, a focus on MHPs, but you want to talk about any self-storage opportunities you're looking at?
Yeah, so we actually are. We have one. Excuse me. We have one storage facility right now that we are negotiating a contract for. It's out in the Buffalo area. It's a few hundred storage units with an office component that we would probably convert to climate controlled storage, which is pretty attractive and very popular these days. And that's the only one we're looking at right now. Like I said, I think mostly, we're probably going to be in that 75 to 80% MHP properties versus storage unit properties. But we are looking. We have a couple of good brokers that are scouring the various states for us, looking for properties.
Okay. This is a question about the legal structure of your fund. Do you know if this is a 506B or a 506C registered security?
We are the one, and I have to check the documents. We are the one that can't overtly advertise.
So this is a 506B. Okay.
Okay.
Okay. And then
this is our first fund, so I'm not super clear on all the terms.
Yeah, and I probably should have had a little opening, or we should have, Jeff, that if this is a 506B, offering, then this is only going to be offered to accredited investors.
That's correct.
So, okay. And I guess I also should have said this is information only, and nothing said here should be considered as investment advice, especially for Jay Shock there with his pink pillow he's laying on. So, okay, back to the questions. Okay, have in your last since you said it's been 5 years now since you've had passive investors, you said?
Yeah, about 5 years. Yep.
Okay, how many quarters have you guys missed making distributions in those 5 years?
So far we've had 2 properties that haven't met expectations. One is a retail plaza that we still own, and that's with no fault of our own. It's COVID related. Our major tenant in there is Planet Fitness, and they shut down in last March. They just reopened in October, and they're starting to pay the rent again and catch up. We worked with the bank to we had deferred our mortgage for quite a while. Now we're on interest only, so we can catch up on property taxes. So for that particular property, all the bills are paid. We have not been able to pay distributions on that since March. March was our last one. We're trying to sell it if we can get the right price. We're not going to give it away, but we only have about a half a dozen investors on that, and they totally understand the situation. And which actually leads me into the reason that we want to sell it. We want to deploy our capital into the MH and storage unit space. Our collections have been as good. Our collections have been as good as they've ever been. Since we've owned mobile home parks and storage units. We're depending on the property, we're anywhere between 90 and high 90% on collections.
Does that 90% on collections include since April?
90%. Yeah, we just looked at it actually from March of 20. We were in the high 90s, and September of 20, and we're in the low to mid 90s.
Okay, got it. That's where the term recession resistant comes from. That some people like to use in this asset class.
Yep. And not only that, David, what's so nice about the parks and the storage units is the multiple sources of income. I mean, with the storage units in the mobile home parks that are in this fund, ladies and gentlemen, we're going to have thousands and thousands of sources of income. Whereas like a plot, like a 100,000 square foot plaza, you might only have 10 tenants in there. Where we're going to have thousands of tenants all paying rent. So we really, really like the stability of the parks and the storage facilities, and just the month after month of cash flow, stable cash flow.
Okay, are most of your properties sourced through brokers?
Yeah, I would say probably 80% of them are. We do have some mom and pop parks that we have bought in the past, and that we continue to look. We do a little bit of cold calling and some mailings, but primarily it's through brokers. They do a lot of good work for us. They set good pricing expectations for the park owners, and so about 80% brokers and 20% off market, or through our own devices.
If you had to, again, it's a range, but what's your lot rent range in your portfolio? Per lot rent per month.
I'll let Brian answer that.
Here I am. So on an average, we're right around $400, depending on location. Probably the lowest you're going to see in upstate New York is about $360 to $375, and some of the parks that are closer to the Rochester area were closer to $500.
Okay. And how about the homes? What are you renting the homes for?
So So, for example, we have a park that's just outside Rochester by uh, 15 miles or so, and those are renting for $1,100 for a single wide, 3 bedroom, 2 bath, um, and that would go for a home from like like 2014, 2015 to brand new ones. So, we broke that $1,000 barrier. So, and we still have a waiting list for the parks that are in and around Rochester. And a lot of it's based on a driving factor is school districts. Some of these parks are in phenomenal school districts in upstate New York. So that's going to lead the rent to go north of $1,000.
Um, does every property have a full-time on-site manager?
Yes. So what we like to do is employ an on-site manager. They'll live in the park. They'll be our eyes and ears in the park, and that's worked really well for us.
Okay. Okay, here's a question about another New York State question. Evictions. Have you guys, has there been any trouble with just evictions, with the legal issues in New York State?
Brian, you want to take that one too?
Well, right now, yeah, sure. So right now there's a moratorium until it's as far as I know, January 1st. So hopefully we don't see an extension on that. But right now we're just starting to serve our 30-day petitions, and at that point we'll be in line once the courts do open. But like Jeff was saying, our collections are so good that it really hasn't been too much of an issue as far as the pandemic. So
Okay.
we do have those. We do have the a few tenants that are taking advantage of the moratorium, and we are like I said, we are in line once the courts open to get those people out, but they're few and far between in this arena.
Okay. We have a last question here. I'm sorry, we have two more questions. First one is average expense ratio.
Yeah, we run pretty close to the national average, right around 40%.
Okay. And that's basically the expense. Okay. And then with this fund, how long do you think it's going to take to fully invest the 20 million of equity?
So our goal is to have the 20 million raised by late January, early February. My goal is to have it all deployed by late 21, early 22. And
okay.
Also too, so after we close on the 3 properties that are under contract right now, there will just be capital commitments. So we won't ask for any more money until we actually need it. So say, for example, we put a property under contract in the spring and we close in, a couple months thereafter, approximately 10 to 15 days before we close. And I'll be keeping everyone apprised of what's going on in the meantime, but officially about 10 days before we close, we'll send out a capital call where we'll be requesting X percentage of your commitment.
Okay.
And also too, so once you provide those funds, just like what I said earlier, if you invest now, you would start getting additional distributions on that commitment the following month after we close.
Okay, I'm glad that came up. So this is a commitment fund. So if someone commits for $100,000, you might call that in 3 or 4 different transactions over 18 months.
That's correct. Yep.
Okay. Okay. How about I know if you had to put parks in 1-star to 1-star to 4-star parks, what would you think your parks are?
1 to 4. I would say in between 2 and 3s. Probably more 3s than 2s.
Okay. That one in Applewood, that's a pretty nice one.
Yeah, I guess I would say that one would probably be,
3.5.
I don't know, what do you think, David? What'd you say?
3.5.
Three and a half? Okay.
Okay.
Yeah, so if you say that one's a 3.5, then I would say more, our parks are more 3 to 4 then, based on what you just said.
All right. Well,
It's you know, it is very arbitrary, you know, it's a little arbitrary.
sure.
But,
Okay.
you know, even our worst park that has like the oldest of the homes, you know, it's stuff in the 70s and early 80s. You know, we do our part to, as park owners, to make it look the best that it can. Our on-site managers and our regional managers are really focused on, you know, a few big things. One, of course, you know, biggest, of course, is rent collections, and rent collections and vacancies. And then the other very important things are cleanliness. We don't want any junk lying around. There's no unlicensed vehicles, no just extra trash around. Most of our parks will provide 1 or 2 roll-off dumpsters every year for residents to get rid of their extra stuff. It's just, you know, even though this is affordable housing, everyone deserves and has the right to live in a peaceful, you know, well-kept place. We don't allow any dogs over 20 pounds. We really hammer on those things to make our parks, you know, an attractive product.
Okay. We got about 3 minutes left before 9 o'clock, and we got a question here about screening tenants. Do you have any what thing you want to share with us about requirements for screening tenants?
That's all Brian too.
Yeah, so yeah, we take this very seriously. We use a in Rent Manager that they have a vendor. It's called AmRent, and we send every prospect through AmRent, and we print out their background report, and we're looking at things like of course we look at income, we look at how many times they've moved in, say, the last decade. That's a big indicator on what's gonna, you know, come. We look at what else? We always call the yeah, of course, the criminal. Zero tolerance for sex offenders, because that goes through the park like wild. So we take that very seriously. We don't entertain any type of sexual criminal. So yeah, we contact the supervisor, we contact the current landlord, we make those calls, every single prospect, and all the property managers that are under us, we make sure that they do the legwork. So we, for the most part, the tenants that moved into the parks on our watch, we've had a lot of success with it.
Okay.
And a lot of it takes, like Jeff mentioned, the whole 20-pound dog limit. It's important because it sets the tone to, yeah, it's your home. You live in the park, but there's rules. So whether you think it's a stupid, silly rule, it is a rule, and it kind of sets the tone where, this isn't the Wild West. They can't have a bonfire, beside their single wide home and expect that's okay. So it kind of it works to flush out the people that are like, oh yeah, well, my dog's 50 pounds and I'm moving it anyway. So we take that very seriously.
Okay. Well, I want to thank Jeff and Brian very much for meeting with us tonight. And it's 9 o'clock, so I want everybody to feel confident that this is the end of our official gathering. I believe this has been recorded, and I should be able to attach it to our follow-up email that'll come out tomorrow. Again, it's awesome to see a lot of you, and it was wonderful to get the RSVPs and just to get back together like this. So Jeff and Brian, are you guys willing to hang out for a little bit if anybody else wants to ask questions
Absolutely.
Okay.
Yep.
Well,
sure thing.
Thank you, everybody.
Thanks for arranging it, David. Thanks.
My
Yeah,
pleasure.
thanks, David.
Yeah, thanks, David. Appreciate it.
So and then you can see Jeff's email here, and and Jeff's contact info will be in the follow-up email. And you can always just get a hold of me too if you want to get more information. So hope everybody has a good night, and I guess I got to work on our next one of these. So we didn't talk much about self-storage, I guess. I don't know. Is there if anybody's hanging around, anybody want to hear any more about self-storage or?
Absolutely.
Okay.
Any particular questions or?
Have you guys done any new construction, like build outs on any of your current properties?
For storage units?
Yes.
We have not. We have one property outside of Rochester where we do have the ability to do so. I think that's something that we're going to start looking into for 21. It's right now it's just a drive up non-climate controlled facility. I think what we're going to do is do maybe a small, maybe 5 to 8,000 square foot climate control, and see how that goes, and then probably put a few more drive ups too.
Are you seeing that that's demand in your area, like through a feasibility study, or are you just seeing competition why you need the climate control?
Feasibility studies. Yep.
Okay.
And there's just in that particular area, there's no climate control, so it's a pretty easy one. We just got to get to it.
Okay.
We got a question from Hero. Any concerns that other types of commercial real estate might be converted into self-storage, and how that might, I don't know, bring in some low basis competition?
I know that's going to be deal specific. So yeah, it certainly is something to look into, because we are going to be seeing a lot of vacant office and retail spaces. So it's just going to be location specific. We're already seeing some of that here in Rochester. We're seeing some of the big box stores. I'm sure you guys are seeing it in your cities where they're being converted to Life Storage and other type of national storage facilities. Most of our storage facilities though are not going to be. We're not going to do a conversion. They'd be something that would already be standing and cash flowing at the time. And the other thing too, with most of those conversions, of course, actually all of those conversions, they'll be climate controlled. There's still a need for non-climate controlled storage.
Okay. Well, any other questions from the crew here, from the guests, or kind of ready to wrap up, I guess? Okay. Well, I guess we'll call it a night. And Jeff and Brian, sure appreciate you guys, and I look forward to seeing what kind of interest you get, and kind of maybe you'll get some harder questions from folks when they're one-on-one.
Yeah, we're good with hard questions too. So anytime, just give us a call.
Okay. Well, take care, everybody. Have a great night. Bye-bye.
Thank you.
Thank you.